Welcome to FinStreet. Q2 FY23 has been a record quarter for the banking sector on many counts. So joining me on the show is Mr. Darpin Shah, research analyst at Haitong Securities, who has been tracking banks and NBFCs for a long time. Welcome to the show, Darpin. Let me begin by asking you, Q2 FY23 has been a record quarter for the banking sector in terms of profitability and other counts as well. Can this trend continue, and how do you see the profit momentum for the banking sector going ahead?
Yeah, thanks, Abhishek. Thanks for having me. So, as you rightly mentioned, the profits for the sector were at historic highs, and this was a very broad-based profitability, which was driven by various parameters. So, our universe is roughly around of 25 odd banks, and they have reported a cumulative profit of almost 55,000 odd crores, which has grown by almost 55% on a YOY basis. So, as I mentioned, the profit drivers was across parameters. Net interest income has grown, other income has bounced back, provisions and OPEX were steady. So from here on, what we see is while credit growth and credit quality might sustain and remain better, margins will be one thing to look out for. We expect some moderation in margins going forward, and that will lead to a growth rates in profitability to moderate from here on. More or less, it will be a normalized earnings which we should see for the sector as a whole.
Well, Darpin, you spoke about the loan growth momentum being strong. So it has been pretty robust for the sector as well, and one of the best in last many years. So what, according to you, is driving the loan growth? Now, capex demand is still missing. However, corporates have bounced back given the fact that money market rates have increased. So how do you see the loan growth going ahead?
As you rightly mentioned, the growth is at a multi-year high, and it is again very broad-based. Retail, services, both these segments are growing at almost 20% plus. Corporate has been slightly lagging at 13%, but we are encouraged with this 13% number as well because it is at a almost 8-9 year high. Capex growth, what we think is will be somewhere in FY24, second half of FY24. We'll see this capex demand picking up for the sector, and that should help the banks. So we don't expect around 20% growth or 18% growth for the sector as a whole. The current rate of high teens or high mid-teens should gradually moderate in FY24-25, and we should be somewhere around say 13-14% kind of a growth for next couple of years as a sector.
Well, you also spoke about net interest margin tapering down from current levels. So how long or by when can you start seeing tapering down of the net interest margin from the current levels that we have seen in Q2?
Yes, so margins for our universe, if you have a look, has improved almost by 50 basis point, for the sector, at the maximum level. This was a combination of lower CD, improving CD ratios, lower slippages, and also not to forget the most important part, of EBLR being, or the floating rates being, loans being getting repriced. So that was an advantage. We believe most of this has already happened. Now we have been seeing that, last couple of quarters, the cost of fund is gradually improving or increasing, and that should continue for next couple of quarters. So by FY24, first quarter onwards, we'll see some kind of margin tapering down for the sector as a whole.
Well, Darpin, amongst the loan growth, this time around, apart from retail and corporate, we also saw SME loans coming back. So what is your view on the same? Can the SME loan growth actually help in loan growth for the banking sector as a whole going ahead?
See, the overall services part is almost 25-27% of the segment. There were various challenges over the last 3 to 5 years, whether it was demon or COVID or various other granular issues were there. So what we think is, as economy progresses, gradually healing continues. MSME being the main part of the sector will continue to do well, albeit at a slower pace, but that will be the key for the sector's growth as well.
The other segment which has been doing pretty well over the last few quarters, or let's say couple of years, is the retail segment. So Darpin, do you see ballooning of retail segment in terms of the loan growth, or do you see headroom for the retail loan growth to continue to remain robust going ahead as well?
Yeah, so as I mentioned, retail growth has been 20% at the end of September. But one should look at the base quarter as well. The base month as well. Last couple of years, we have relatively slower growth in retail as well. So because of the base, we are seeing this high 20% number. We don't see at the system level ballooning of retail loans as of now. If you look at the penetration, say for a couple of products like credit cards or for home loans, credit cards is just 4% penetration, home loans is roughly 10-11% penetration. So enough headroom for growth, as the penetration improves for the sector as a whole.
Well, my final question to you, Darpin, do you see the large caps versus the rest of the field outperformance to continue going ahead as well?
Yeah, my preference will be towards large caps despite the valuation gap. The simple reason is they are far more better placed in terms of a liability franchise, capital, as well as asset quality. So our preference will continue towards large cap banks.
Well, that's the word coming in from Darpin Shah of Haitong Securities, who believes that, loan growth momentum will sustain going ahead, but it may taper down. However, he also believes that retail loan growth will remain robust going ahead.